Okay, in this section, we're going to discuss about annuities, methods of saving and investment. In previous sections, we already discussed about simple interest and compound interest. So objective for this section are find the value of annuity, determine the value of annuity, determine regular annuity payments needed to achieve a financial goal, and then we try to understand the stocks and bonds as investment, understand accounts designed for retirement saving. These are the main objective. Annuity is actually a sequence of equal payments made at equal time periods. For example, if you buy a house, then you pay monthly for a certain amount of time. That is an annuity. The value of an annuity is the sum of all deposit plus all interest paid. For example, you buy a house for 450,000 and then you make a payment every single month. At the end of that mortgage payment, let's say for 30 years plan, whatever money you pay at the end of that 30 years, that's called value of an annuity. This is the formula for to calculate the value of annuity. Let's say if you make deposit or pay, P is the deposit made at the end of each year for an annuity that pays an annual interest rate R. So R supposed to be in decimal form, compounded once a year. The value of A of the annuity after T years is this. So you are making payment yearly. This P is yearly. Then this is the formula. There is another formula for if you make n times a year. This is 1 times a year and this is n times a year. So for example, if you do a monthly payment, then n becomes 12, and then we can use the very same formula for finding the actual amount or value of the annuity at the end of that time frame, T years. Okay, so the deposit. So let's say, for example, if you want to, if you already know that the amount you want after certain time, A, let's say you want to save 450k in 30 years, and there is a package which pays you R percentage as an interest rate, and if you want to find out how much you need to make a payment every single, let's say n times a year, maybe monthly or maybe daily or maybe weekly, depending on your situation, this is the formula. So P gives you the amount you need to deposit every single month or every single week or every single day, and A is the amount which you need at the end of the T years. Okay, so let's try to do some examples using those formula of annuity. Depending on which situation we have given, we're going to use those formula. So first of all, fill in the blank so that the resulting statement is true. This question needs information about the stock investment as well. So let's go back to the information. You might have different type of investment, like you can save, you can invest, you can just deposit money in a bank and bank pays you certain amount of interest rate. That's one type of investment. But sometime you might want to invest in different type of things, maybe stocks and bonds. These are some example. So question is, what is a stock? So stock means there is a publicly traded company and you want to buy a share, a piece of that company. That's called a stock. So investor purchases stock, shares of ownership in a company. For example, let's say there are 1 million shares of a company, publicly traded company, and out of 1 million you own 20,000. Then in that company you have 2% of ownership. So you can take any example, let's say very well-known example, a well-known company, publicly traded company, let's say Apple. Let's say Apple has, this is Apple, this is the whole Apple company. Okay, Apple company, and the Apple company is a very, very big company. It's almost 3 $1.5 trillion market cap company. So we divide this company into, let's say, different pieces. To understand the concept, let's assume that we divide that whole Apple company into 1 million pieces. 1 million. Then you want to buy 20,000 of those pieces. Then that means 20,000 out of 1 million, which is 0.02, which is 2% of Apple company. You own that 2% of the company. And you, in that example, is considered or called as a shareholder. So stock means the piece of the company, and then if you own the stock, you are a shareholder. Okay, so you can buy or sell the stock. That process is called trading. And so you can trade, buy or stock in a stock exchange. There are different types of stock exchange. In USA, there is a New York Stock Exchange, there is a NASDAQ. So there are different types of stock exchange. It means like a place where you can buy and sell stock. If you, after owning stock, if you sell and if you make a money profit, that's called capital gain. So let's say initially you own 20,000 of Apple share, and then cost of one share of the Apple is 250. Then cost of 20,000 of Apple share is 250 times 20,000, which is 1, 2, 3, 4, 5. So it's 5 million. So you invest 5 million in Apple company by owning 20,000 of stock, and then finally after some time you sell that for 6 million. Then you made profit, which is the difference between these two numbers, which is 1 million. That is called capital gain. If you lose, then that's a loss. Sometimes if you own part of the company like a stock, they pay dividends. They distribute their profit, and that money is called dividend. Okay, so instead of stock is very volatile. It might go up and down. So sometimes what happens is the company, they need money, so instead of selling stocks, they sell bonds to raise money. Bond means, let's say Apple company, the very same Apple company, they need money. Okay, this is just a hypothetical situation, hypothetical example. Okay, and now they say, okay, we need some money. Let's say we need $1 billion. So we would like to raise this $1 billion. So we need that money. So they are going to sell bond, meaning, hey, if you want to buy Apple share in, let's say, 1 year, we are going to sell you that share, $250 per share in 1 year. So if you buy that type of agreement, that's called bonds. People who buy a bond are lending money. So if you are buying the bond from the company, so actually you are lending the money to the company. In this case, it's Apple. So if you have a bond, the difference between the bond and the stock is, in a stock it might go up and down. Okay, bond, the company has an agreement with you to sell stock after 1 year in certain price, and by owning the bond, by lending your money to the company, they are also going to pay you some interest. Okay, so bonds are a commitment from a company to pay the price an investor pays for the bond at the time it was purchased, called the face value, and then also the interest payment. They also pay you interest. Okay, and let's say you have different type of stocks. You have real estate, you have different technology company like Apple, Amazon, and things like that, and everything in your portfolio, that's called financial portfolio. So a listing of all the investment that a person holds is called a financial portfolio. For example, let's say you have 1 million. Out of 1 million, you put 500,000, which is 500,000 in stocks, you put 200,000 in bonds, and then you put rest of the 300,000 in real estate. So in your portfolio you have stocks, you have bond, and you have real estate. That's called financial portfolio. If you have different type of things in your portfolio, that's called diversified portfolio. To manage the risks, people, they would like to diversify. Even one thing goes down, another thing could come up, and then you minimize your risk. Okay, sometime if you want to know more about the stocks, you might go to the online, and then you can find this information. I'm going to just show you one example here. For example, let's say, because I'm talking about the Apple stock, so let's say Apple stock. When you Google Apple stock here, it gives you the different information. First of all, the ticker symbol, this AAPL, that's the name of the Apple stock in a stock exchange. This is the Nasdaq. It's one of the stock exchange place, Nasdaq. And then you can find different information about this stock here. Like for today, the open price for the Apple stock, one stock was $241.22. And then today the high price was $246.30, low price was $240.21. The market cap, that is the whole Apple company, with this price can be on, the total cost is $3.64 trillion. P ratio is the price to earning ratio. In this case, it's a 37.32. Earning means how much money Apple is making. If you divide the price of the stock, divide by how much money Apple is making per stock, that ratio is called P ratio. Dividend yield means Apple pays dividend, which is 0.42%. So those are the information you can find by googling the ticker symbol or company name online. Okay, so here this is the name of the company, this is the stock exchange, which is called Nasdaq. This is the symbol. When you trade, this is the symbol it's going to appear, and the price you see, that's the closing price of previous day. Today is let's say weekend, Saturday, then previous day market close at price $145. Okay, so there are different type of information: open price, high price, low price, 52-week low, 52-week high. 52 weeks means it's a 1 year. In 1 year the price high. If you go to the real data, this is not the real data, this is data from very old data. If you go to the real data, as you can see here, 52-week high in from 2024 to 2025, 52 weeks, $260 for the Apple stock. 52-week low, it's $169. Okay, yeah, so those are the 52 weeks high and low. In the final column of the chart, volume refers to the number of the share traded on July 9, 2021. So let me see if there is a volume here. Do I see here? Not in the volume. This volume, it was 163.74 millions of stock that was traded on this day, which is September 19, 2025. That's the volume. Okay, we already know the market cap. If you multiply all the available stock times the stock price, that gives you the market price, market cap. It's a total value of the whole company. As I already mentioned, P ratio means closing price per share divided by annual earning per share. Okay, so okay, let's go and try to see some examples before we go to the next topic. The first example: shares of ownership in a company are called stock. If you sell shares for more money, then you make money and you make the profit, and that's called capital gain. Some companies distributed all or part of their profit to the shareholder as a dividend. Just the testing. Let's go to the next. A listing of all investment that a person hold is called a financial portfolio. It's a portfolio. It's a portfolio of stocks or bonds or real estate, different type of thing. To minimize risks, it should be diversified. Diversified means if you just invest in one of the type, then if that type goes down, then your risk is very very high. But if in your portfolio if you have different type, then that's called diversified. Then risk is low compared to just owning one type of stocks or bonds or real estate. Okay, let me find out some problem. What is that? These are just the information. Okay, here is the first question. Find the value of annuity and an interest round to the nearest dollar. So if you go back to the formula here for the annuity, there are different type of formula. Depending on your situation, you use one of the formula. Okay, so let's go here and read the question. Periodic deposit $1,000 at the end of each year. So it's a once a year. So this is the formula we're going to use, the first one. Rate is 5.5% compound annually. Time is 6 years. So just plug P equal 1,000, T equal 6 year, and rate is 0.055, and then do the calculation. So I'm going to use a calculator here. So I'm going to just calculate the value inside the bracket first. Parenthesis 1 plus rate is 0.055. I just close the parenthesis, take the power is time, which is 6 years, and then multiply, subtract 1. Look at here, subtracting 1, and that is the value inside the bracket. Multiply that value by a regular deposit, which is periodic deposit, $1,000, and then finally divide that by the rate, which is in our case it's a 0.055. If you do that, this is the annuity. At the end of 6 years, this is the amount you're going to get for that investment. So keep in mind, if you invest $1,000 per year for 6 years, your investment is 6 times 1,000, which is 6,000, and then the leftover money is your interest. So the annuity is 6,888, and then the difference is the interest. Okay, what is this? How much will you have saved at the end of the 5 years? This is a very similar type of question. You need to find out the right formula. In this case, the school district offered teachers the opportunity to take a year off to earn a master's degree. To achieve this goal, you deposit 2,000 at each end of each year. So this is the same as question number 12. Okay, what is this? So this is the different type of situation. Periodic deposit is $900 at the end of every 6 months. So this is not the right formula. You are going to use this formula if you are looking for annuity. So this formula, because it's a 6 month, so there are 2 6 months in a year, so n supposed to be 2. So whenever you try to use this formula, let me just use some blank page here so I can write down information. Okay, so the right formula is the second one. So the annuity, the value of annuity, A is equal to periodic deposit inside the bracket 1 plus R over N to the power N times T minus 1 and divide by R over N. Remember, P is a periodic deposit. In this case, it's a $900. A rate is a 5%, 0.055. N is how many times in a year? It's a 2 times in a year, because every 6 months means there are 12 months, so 2 times a year. So N is 2. N times T means 3 years. T is 3 years, and N is 2. 2 times 3 is 6 minus 1 divided by 0.055 divided by 2. So this is the calculation we do. So for this calculation, you have to use a calculator. And the way I do is I try to compute the thing inside the parenthesis and take the exponent 6, subtract 1, and then multiply that number by 900 and divide that number by this. So let me just do that. 0.055, this is where I'm going to start. Divide by 2 plus 1. I divide this by 2 and then add 1, and then take the power 6 and then subtract 1 from that. So that is the calculation inside the bracket. Multiply that by 900 and divide that by parenthesis. Do not forget to give the parenthesis. 0.055 divided by 2. So that's the annuity. So if you deposit 900 bucks every 6 months, so in a year you are depositing 1,800. In 3 years it's almost what is that? 1,800 times 3 is 5,400. But this is the amount you are going to get with this plan. So 5785, and then difference of this one minus the deposit, which is, remember, in a year, 9 month, in a $900 in a year, there are two times deposit, which is 1,800, and you are doing that for 3 years, which is 5,400. So the total amount you are investing is 5,400, but the total amount you are getting is 5,785. The difference is coming from the interest. So the answer is this one, because the difference is 385. Let's go periodic deposit. Okay, in this case, this is the formula number 3, because you want to find out how much money you have to deposit at the end of each year for next 12 years, so that ultimately after 12 years in your account you have 15,000. So A is 15,000, rate is 8%, N is 1 because once a year. So we're going to use this formula. So I'm going to calculate the value inside here. Let's say A is 15,000, that's the goal, times it by R over N. R is 0.08, divide by 1 because it's a once a year. This number is on the top part. On the bottom part, you have to calculate this value, which is 1 plus 0.08 divided by 1 because it's a once a year, to the power n times t. N is 1, t is 12, so to the power 12. And then I forgot to give, I need the bracket here, so my calculation is not going to be right. I forgot to give the bracket. So let's say the top part is 1,200. Let's just keep that thing. So top part is 1,200, and then we need to calculate the bottom part, which is 1 plus R over N to the power N times T minus 1. So 1,200, and I'm going to calculate this. Sometime it would be very confusing for the calculator if you don't use the command properly. So I'm going to calculate this thing, which is 1 plus 0.08 divided by 1 because that's mistake. I'm going to do this, parenthesis 1 plus 0.08 divided by 1, N is 1, to the power 12 minus 1. So that is the number on the bottom part, 1.518170. So I'm going to just 1.51817011 and then keep going. So I'm just going to do it 2. Okay, that's a rounding. So now just type 1,200 and divide that by this number. So that can also be done by this times 1,200. I did 1 over x, means the number I got, I put it on the denominator. So this is the value you are going to get. So every single year you have to deposit $790, $792.42, 43 cents. So if it's rounding, then it's a $791 at least, because if you deposit 790 only, then you are not going to achieve 15,000. More than 15,000 is fine. So $791 per month. Okay. Okay, let's go back and then find out what else we need. So, okay, so that was the investment. Sometime you also have to understand the retirement saving. That is also a type of investment. If you are contributing in traditional retirement account, then you can contribute that pre-tax money. You don't have to pay the taxes, but you have to wait until you get retired to get that money. And when you get retired, if you are contributing in pre-tax money, then you have to pay the taxes when you try to withdraw the money from the account. Okay, but there is another account that's called Roth IRA, which is where is that? Roth IRA. This is also a retirement account. You can contribute 7,000 or 7,500 depending on which year. I think this year it's a maximum 7,500. You can contribute that money to the retirement, and you can invest that money, and then eventually that money would be after tax money. But what is the good thing about the Roth IRA is, after you get retired at certain age, you have to check this time, because this time in this slide is taken from the past couple of years, so maybe it's a different number. After you get retired, you don't have to pay the taxes. So that's the beauty of Roth IRA. So I really encourage you to Google about Roth IRA and try to understand. This is just a different retirement account. Okay, that's all for this section.